The topics and opinions expressed in the following show are solely those of the hosts and their guests and not those of W4CY Radio, its employees, or affiliates. We make no recommendations or endorsements for radio show programs, services, or products mentioned on air or on our web. No liability, explicit or implied, shall be extended to W4CY Radio, its employees, or affiliates. Any questions or comments should be directed to those show hosts. Thank you for choosing W4CY Radio.
Barry G. Fowler, EA, brings you Tax Talk for You right here on W4CY Radio and Talk4 TV. As an enrolled agent and a national leader in tax resolution, as well as trucker, bookkeeping, and tax planning with over 30 years of experience, Barry will break down taxes, bookkeeping, tax planning, and tax relief for individuals and businesses just like you. So let's have some Tax Talk for You with your host, Barry G. Fowler.
Hey, welcome and good morning. It's starting out to be a regular Monday morning, where everything possible goes wrong. The office internet is down, which means, it shuts your phones down. It shuts work down, all that. So I'm here doing radio from the comfort of the ranch, and trying to get everything working. And as you're going through, your first camera wasn't working, and then your microphones weren't working, and then your screen, because you adjusted it, starts shutting down. It's a Monday. It's just the way it is. But it's a good Monday morning because it's another start to the week where we can get a lot done and get a lot of information out there. And that's what we're talking about here today, is preparing your Schedule C for your 2025 tax return. We'll also get in answering more questions that we've received about overtime because people aren't seeing it on their W-2s. All these things will be discussed here today. And then if you got questions, of course, hey, go ahead and put them in. And the other thing I tell everybody is, hey, never miss an episode. We are here on W4CY Radio every Monday at 10 a.m. Eastern Time. If you go over to our Facebook page at Tax Talk for You, the number 4, letter U, you can follow us over there and never miss an episode of Tax Talk for You. And if you do happen to miss it, we're also have everything on podcast. So you can go over to iHeart, Spotify, and all the other major podcast places, and we will be listed over there as well. Hey, now talking to everybody. If you're a small business, independent contractor, sole proprietor, single member LLC, you're going to be filing your 1040 with a Schedule C. Now, remember, the 1040 is just a statement of all your personal income. The Schedule C is a form that is the detailed record of your business income and your business expenses. Second jobs, maybe your full-time business that you're running could be filing as a Schedule C. I'm always going to tell you, you went out and got an employer identification number. And on that employer identification number, when you get the letter from the IRS, it says, hey, this is how you have to file. So if maybe you put it in as a multi-member LLC, Schedule C is not for you. That'd be a 1065. Maybe you went in and did a corporation. It would then tell you to file an 1120 unless you made the S Corp election. But if you're a sole proprietorship, single member LLC, it is going to tell you to file the Schedule C. Now, Schedule C is moderately complex, but it really requires accurate business records and keeping those, throughout the year. And if you're keeping track of that throughout the year, it saves you a lot of time when you sit down to prepare your tax return. So therefore, I always say, hey, make sure you got good record keeping. It's really hard to go back and figure out what your record should be, what your expenses should be in hindsight. Going back and looking at all your bank statements, deciphering what's business, what's personal, especially if you have a Schedule C business and you're running it through your own personal checking account that you never set up a business account for. becomes a little bit easier if you do have a business account set up. So you're going to first make sure you qualify, as a sole proprietorship and everything else. So you're going to want to make sure you are qualified. So if you're an independent contractor, hey, maybe you qualify and you should do that. Maybe you're a misclassified employee. You have to look at who controls your time, your schedule, and everything else, and then talk to the person that's you're working with, employing you, so to say, and figure it out, from there. Now, there are two different forms of Schedule C. There's Schedule C and Schedule C-EZ. The EZ is really easy to complete, but I will say this, most people aren't going to qualify for it. To qualify, you must only have one business, no employees, use the cash method of accounting, and your business expenses can be no more than $5,000. So that would be your Schedule C-EZ. And they're saying basically that would be an easy form for you to fill out and only be up to $5,000 in expenses. But if you're in business, generally you're going to have more than $5,000 in expenses, especially if you're really running it as a business. So now you determine you got more than 5,000, you're going to file Schedule C. Schedule C is going to be a more detailed look at the profits and losses of your business. Many kind of expenses can be deducted from your gross revenue. So the greater your profit, the greater your tax liability. So, man, it really, really behooves you that you're going to have to do everything you can to minimize the tax and minimize the profit that you're making just within the law, though. You're not going to take deductions that don't apply to the business, that are personal expenses. You're going to be looking at expenses that apply to the business. So now, if you can't document a deduction, you're going to run the risk of civil and criminal penalties if you're ever audited. So don't claim things you can't deduct. You can't document, or that you can't deduct. So Schedule C has a pretty comprehensive list of things that you can deduct that are on there. And you can look at the Schedule C yourself. So you'd be able to look at it and say, hey, these are the things we can document. There's a lot of things that aren't on there that you could also to take as well. So, you're going to want to go through all the expenses of the business and don't miss the little things, and, go through it and start itemizing all your expenses, marketing, even advertising, dues and subscriptions. If you're running contractor, subcontract work. And if you do have subcontractors, make sure you're sending in today and sending out to your contractors your 1099s, get them out, and then get them submitted to the IRS. Lease expense. So if you're have storage space, or maybe you're renting office space, make sure you have all those expenses that are out there. Insurance for the business, not health insurance, but actual liability insurance, things like that, workers' compensation, all those would be deductible as well. Office supplies, things you're using for office, paper, pens, invoicing, if you're printing things, things like that, all the office supplies that you can think of would be deductible. Auto. Now, if you're a trucker, owner operator, your trailer and your tractor are both going to be deductions. They're going to take depreciation on that. If you have a personal vehicle and you're using it for business, you're going to be looking at deducting mileage. But you got to keep track of mileage. You get a mileage log, where you went, who you went to visit, what was the business purpose. Even if it is going to the office supply store, or maybe even you're going to Walmart and picking up supplies from the business, those are deductible business trips that you can deduct for your auto. If you're running a business and you have equipment, repairs and maintenance, that includes repairs on your tractor or your trailer, all those are deductible expenses. Now, repairs have multiple facets to it, so you're going to have to look at some details on whether it improves the useful life of the vehicle, or if it's just the standard repairs and maintenance. It changes the deductibility and how you're going to deduct it. Travel expense. So airline, lodging, food, all this becomes deductible in travel as long as it has a business purpose. Not personal travel, business travel. So if you're running a corporation, hey, that'd be a little bit different. You might have board meetings and other meetings that you go through. But if you're going for continuing education, you go out of town, that travel, airline tickets or mileage, hotel, food, all that becomes a deductible business expense. So you're always then looking for little things as well, things that you're using within the business to get that deduction. And so everything that you can find that relates to business is what you're going to be doing for your business and getting your deductions. We're going to go through some more business deductions right after this short break, and we'll continue talking about how to minimize the profit to minimize your tax. We'll do that right after this.
We have only scratched the surface of today's show. Please stand by as Barry G. Fowler will be right back with Tax Talk for You. If you owe the IRS or are going through an IRS audit, don't go at it alone. Call Taxation Solutions Tax Relief at 888-930-1016. We are your solution for IRS debts, audits, back taxes, garnishments, liens, and levies. Whether you're an individual or business, you need a solution and a strong, aggressive tax resolution. Don't let the IRS walk all over you. Stop the IRS now. Call 888-930-1016 or go to taxationsolutions.net now for a free, no obligation consultation. Let's get back to Tax Talk for You with more Tax Talk. Once again, here's your host, Barry G. Fowler.
Thought I silenced that. I guess it hadn't. Hey, we're talking about your Schedule C and what else can be deductible, here for your business and stuff. And another big item might be supplies you're using within the business. Now, supplies could be, up in cost of goods sold, depending on the type of business, or supplies could be also, supplies you're using within the business itself, not as manufacturing a product and stuff for sale. Taxes that you may pay for your business. So as an owner-operator trucker, you might have your fuel tax, your surtax. You're going to have your heavy highway taxes, things like that you're going to be paying IFTA taxes. So you're going to make sure all those are deducted as well. Utilities. Now, not your home utilities. What you're going to be deducting is utilities for maybe your office space or your storage space if you're having to pay utilities out there. And then a big item is wages. If you have employees, then you're going to be deducting the gross wages you're paying them and the payroll taxes that you pay, that the company pays out there as well. Not the federal withholding and the withholding for Social Security and Medicare, because that's all covered in the gross payroll. But it's going to be the matching part that the company pays for Social Security, Medicare, and unemployment, and federal unemployment. All those things will be deductible. And then you're going to be looking for miscellaneous other expenses. Also things like telephone, your cell phone, whatever portion of the cell phone you use for the business would be deductible as well. Now we're going to take a little bit of time and kind of go through a Schedule C and filing. And so what you're going to do is, first thing is make sure you get a copy of the Schedule C. And you can do that over at irs.gov and search in their publications and see the Schedule C. Or you can pull it up in your tax software if you've already paid for your tax software and kind of see it over there. If you're working with us, we have forms that we can use that kind of itemize all the expenses that you can take as an owner-operator. In many other professions, we've got the forms at our office where we can help you prepare the taxes and get you the normal expenses for most different types of businesses out there. So you're going to start out, you're going to put the name of your business and then your principal business or profession, including your products or your services. So the first several lines, it's just basically identifying information about you, your business, and then it's going to ask you a lot of basic questions about your operations. And then you got to provide them with the method of accounting, how much you are involved in the business, and whether you receive Form 1099 forms as well. So you're going to need, your business name again. If your address is the same as your personal address, you don't have to change it. You'll autofill when you're doing the forms. Your EIN number, if you've got one, or if you're just using your Social Security number. I tell people that, hey, look, even if you're a sole proprietor, get an EIN number. Social Security number is not something you need to give out to everybody, but you can definitely give out your employer identification number out there. And then a lot of people get stuck on what we consider sometimes is the hardest question is your method of accounting. You haven't done accounting, so you don't know what they're really asking, but 90% of the people, maybe 99% of the people are on a cash accounting basis. Cash in, cash out. We explain people that, hey, look, it's when you receive the money and when you pay the money out is what the cash basis is. However, if you are running a business that has inventory or sells goods, you might use the accrual method, where you actually record income when you got the order, not when you received the cash. So when you invoiced it, it's then considered to be received. And then when you get bills in, it's considered to be cash out. Even if cash hasn't gone out, it's considered to be an expense. So then your next item is going to be part two. Oh, let's go back to part one. It does ask you a very, very important question. Did you make any payments that would require you to file Form 1099? So that's the 1099 NEC that you would be sending to any contractors working for you. If you mark yes, and then you say no, you did not send them, you will probably trigger an audit. So you want to make sure that, hey, you answer this question correctly. Did you have anybody that should have gotten the 1099? Yes, then yes, I did mail or send the 1099s to them. So make sure you're doing both. Now, if you didn't have any, don't worry about it, because you can just check no. And then you don't worry about that problem at all. But you're going to start moving into part one, which is your gross income. It's going to consist of basically 7 lines. And basically, you're going to follow this going through. You're going to put your gross receipts. So all of the money that you've received in during 2025 is going to go on that line. And that's before you take any deductions whatsoever. This is your gross revenue. Now, one of the things I suggest everybody do is make sure that, hey, if you're going in and doing this into your tax software, if you've received 1099s, go to the 1099 NEC screen and put in all your 1099s and make sure they all go to Schedule C. Then you'll be able to look at the total for Schedule C. Now remember, this is total cash you received in if you're cash basis. So those 1099s may not be all your income. You may be receiving income in via cash. You may have worked for people that did not send you a 1099 as well. All that would have to be totaled up to make sure you got the right number on line 1 of part 2, which is gross receipts. So remember, this is everything you have collected. Part 2 is returns and allowances. So if somebody returned merchandise and you paid them back, returns and allowances would come out there. So then you're going to subtract returns and allowances out of your gross income, and now you have your new gross income after the returns and allowances. Then you're going to have, if you're like in a manufacturing business, you're going to have cost of goods sold. So if you're buying goods, putting them together, or maybe you're running a store and you've got inventory, then you'll have your goods coming in here and you'll be keeping track of inventory and then goods going out. So you have your cost of goods sold. You subtract that out of the above line 3 and you get down to your gross profit. Now that's gross profit before any expenses. Then you're going to take out or add in any other income. So if you got fuel tax credits, refunds, state and local gasoline tax refunds, those all get added back in to get down to your gross income. Whew. A lot of things to do, making sure that you get down to the right line. Now, not every line applies to everybody. So if you're running some kind of practice, gross receipts and gross profit probably be the same thing. And then if you had no cost of goods sold, you wouldn't put anything there. And so the next line item would be actually the same as well. So like I said, not everything applies to every single person. Now, part 2 is where you're starting to put down all your expenses. Like we talked about, you go through and everything you've itemized when you're coming through and doing your expenses. So if you've looked at this stuff, you've got your advertising, commissions, contract labor, depreciation, any employee benefit programs, insurance, not health insurance, interest expense. So interest you've paid out on loans and things like that. Your legal and professional fees, office expenses, pensions and profit sharing accounts, rents, leases, taxes, travel, meals, entertainment, deductible meals and entertainment, utilities, wages, and then a whole bunch of other expenses. So this is where you've got to go through and put itemization to all the expenses that you did, and you're going to list them out here on this form, particularly to make sure that you've got the stuff you need and expenses that you can take. Now, we're going to take a short break, and when we come back, we're going to talk about car and truck expenses and how to deduct them. And we'll talk a little bit more about the deductibility of meals, and we'll do that right after this break.
We have only scratched the surface of today's show. Please stand by as Barry G. Fowler will be right back with Tax Talk for You. As an owner-operator, you already spend too much time away from your family. Trucker Tax Tools handles all your bookkeeping and taxes no matter what level trucker you are. Life on the road can be taxing, but that doesn't mean that your wallet or time with your family should suffer. Trucker Tax Tools makes your life run smoothly. Go to truckertaxtools.com for a free guide that will give you the tools to never worry about your taxes again. Call Trucker Tax Tools at 877-966-2722. 82477 or go to truckertaxtools.com now and let the experts keep you trucking. Let's get back to Tax Talk for You with more Tax Talk. Once again, here's your host, Barry G. Fowler.
All right, now we're going to get back and we're talking about your Schedule C. How do I deduct automotive expenses? You are allowed a deduction for the business use of your personal vehicle, but only after it's met certain conditions. You can actually deduct the actual cost of the business mileage, but you got to document everything. You can use the standard mileage rate. You can use the actual expenses. You got to make a choice and stay with it. So when you're on Schedule C, most Schedule Cs on roughly line 11 are going to give you, or 9 are going to give you car and truck expenses. You click on that line and it's probably going to take you to another screen. And that screen is going to ask you, how many business miles did you put on the vehicle? How many commuting miles did you put on the vehicle? And how many other miles did you put on the vehicle? It's also going to ask you questions of whether or not this is the only vehicle you have. Is there another vehicle available for use, for personal? Do you have evidence? And then is the evidence written? You've got to go through and read and check those boxes. You must have written proof of this expense. I also suggest, if you're going to be deducting a personal auto for business, make sure you start out documenting the beginning and ending mileage every single year so that you know how many total miles were put on there. And if you go back to your mileage log and you're figuring out your business miles, then you know how many other miles were used. This car is used for business. Now, if you're a trucking business and you're using your personal vehicle, what do they consider a commute? The commute would be leaving your house and going to where your truck is. So if you have your truck parked at a truck parking lot and you're going out there driving from home to get your truck, that is not business miles. That is a commute. But if you're going to the store to pick up supplies, you're going to the auto parts place to pick up auto parts and truck parts, that would be a deductible mileage. If you're driving from there to the mechanic shop, or let's say you have the shop at home, driving back and forth, those are deductible miles to be able to get the stuff that you need to supply your truck. So those are deductible. If you're driving to go meet somebody, deductible business miles. Make sure you're tracking everything that you have out there and tracking your expenses and stuff. Now, the other question we get a lot of times is the last part of Schedule C, and it's still part of Schedule 2, and that is the home office. So the business use of the home office, it again will take you to another screen where you're going to put in the square footage of the space you use exclusively for business. And the second part is the total square footage of your house. Now this can get complicated because yes, we try to simplify and just use the total square footage, but you could actually narrow it down and take out the hallways and common areas and stuff in the house. So you've got the entryway and the hallway considered to be common areas, the stairs going up to the room and the hallway going up to the room, and not counting square footage. You can back that out, get you a little bit larger deduction, but you've got to actually be able to sit down and decipher exactly how many square footage is used in these multi-use areas. Now, if you're using a room for more than one purpose, the IRS frowns upon it because it is not used exclusively for business. So if you got a bedroom that you can set aside and nobody does anything in there besides office space, make that deductible. You can actually use the actual expense method, or you can use a safe harbor method. We have done this calculation many times, hundreds of times, maybe thousands of times. And most of the time, we're going to default to the safe harbor method because, if you're just occupying space, then you're just going to take the deduction of, the safe harbor or the actual expenses, there. Um, and it's not going to get much more than that. Um, and unless you're updating the room, and if you are updating the room or adding things to the room to make it usable for business, then it becomes a business expense direct for, maybe repairs and maintenance in that room. If you're having to do general house repairs, then maybe if they're significant enough, we would go to the actual expenses, depending on what the deductibility is. And if, maybe your mortgage interest is enough to be on Schedule A, it might benefit you more to be over on Schedule A than it will be taking actual expenses over there. So it's something you've got to look at and determine, what is the right way to do it for yourself and what's going to get you the larger deduction. Now, the last section in part 2 would be considered to be part 5, other expenses. Yeah, it's a catch-all, meaning you can list a whole bunch of items here. You can list expenses that weren't categorized on, the front page of Schedule C. Other expenses that you may have. So in a trucking business, parking, tolls, scales, things like that would be listed here on miscellaneous expenses. We've seen in miscellaneous expenses, maybe your fuel listed underneath there. Sometimes we'll list it other places, but hey, this is where it's going to be. A lot of times falling on this part of Schedule C. Some people will put telephone expense, your cell phone usage out here, so you can actually put in what the percentages are versus being under utilities. You may have some other type of expenses that you're running that you want listed out, and you could document it here on this page, part 5, and have all the expenses listed down there. So the main thing, you may get categorization wrong. You may put it in the wrong place here or there. But the main thing really is making sure you've got all the expenses that you can take and making sure you've got the documentation behind it to back it up. If you make the mistake and put marketing here on part 5 instead of including it with advertising, then hey, so be it. Maybe you put printing over here and other people put it into office supplies. With the end of the day, if you were to go through an audit with the IRS is going to be looking at saying, hey, look, let's tie these numbers out to your documentation, making sure that you've got it right and making sure that you have the support for the information here. Now, the one thing that I have seen, don't make the mistake. If you're in the trucking business, owner operator out there, you're not getting mileage for your tractor and your trailer. You're taking actual expenses. So don't go and put mileage in the auto category and then deduct fuel and everything back here. If you're deducting your auto mileage for your personal vehicle for business, don't put the part of fuel over here on the miscellaneous string. It's just going to be a red flag and it's going to be a problem. Now, one of the other big red flags that you run into, and we've seen, you're filling out your Schedule C and you're guessing. I think this was my expense. And generally it comes out, and I've seen Schedule Cs like this many, many times, and many times help people through an audit. You're using completely round numbers. So you're guessing and you're putting 1,000 or 2,000 or 10,000 or 15,000 or 12,100, whatever it is. It's a round number. Man, it is a serious red flag. Because generally in business, you're not going to see round numbers on most of the expenses that you go through and do. I don't care how good you are at doing it. Everything is not going to turn up round numbers across the board. So keep those things in mind, making sure that, hey, you have always got all the right documentation and the information that you need available to prepare your Schedule C. Now, if you're not really sure about your Schedule C, hey, give us a call over at Trucker Tax Tools. We can help you at 877-996-2477. We're great at helping truckers, owner-operators through filing a Schedule C, or maybe even looking at converting you to a multi-member partnership and doing a partnership return, getting this trash off your personal tax return, or getting you over to being an S Corp, and again, getting this trash off your personal return and just reporting it to K1 on the personal versus doing all this stuff on your personal return for your business. Hey, we're going to take a short break, and when we come back, we're going to talk about the one big serious question everybody keeps asking is, how do I deduct this overtime? It's not on my W-2, and we'll do that right after this.
We have only scratched the surface of today's show. Please stand by as Barry G. Fowler will be right back with Tax Talk for You. As an owner-operator, you already spend too much time away from your family. Stop spending time doing paperwork. Go to truckertaxtools.com, a solution built specifically for truckers. Truckertaxtools.com makes your life run smoothly. Let's get back to Tax Talk for You with more Tax Talk. Once again, here's your host, Barry G. Fowler.
Overtime. You know, if you've ever worked late nights, weekends, double shifts, you're very familiar with overtime pay. But hey, in 2025, President Trump and the one big, beautiful bill that passed, your benefits got better. So if you've worked overtime, this provision in the one big, beautiful bill, referred to as no tax on overtime deduction, is going to put some of the money you made from overtime hours back in your pocket this tax season. Now, you know, you've seen your W-2, and guess what? They didn't break it out. They weren't required for 2025 to break out overtime. Be prepared with your final paycheck stub to provide that to your tax preparer. So everything you're going to need to know is going to be right here. If you don't listen to any other part of the segment, if you know somebody that is taken and received overtime pay, get them to tune in right now at W4CY Radio. So this provision started in 2025. So it means that we're actually claiming this for the first time here on your 25 tax return in 2026. Now, it's not permanent. This deduction is actually scheduled to remain in place through the end of 28 unless Congress decides to extend it and modify it. So here's what you need to know about the one big, beautiful bill, no tax on overtime deductions. The deduction amount, you can deduct up to $12,500 of qualified overtime compensation per year, $25,000 if you're filing joint. So if you're a single filer and you earned $8,000 in qualified overtime, you can deduct the full $8,000 since it's under the $12,500. So where do you take this deduction? This deduction is applied after the adjusted gross income is calculated. It won't change your AGI, but it can still lower your taxable income, which may then reduce the amount of federal income taxes you owed or would be paying. You can claim this deduction whether you itemize or you take the standard deduction. So You're basically applying this after the adjusted gross income. I think one is funny. I looked at the requirements and it said there you must have a valid Social Security number. Well, you shouldn't be working in the United States if you don't have a valid Social Security number. But hey, that's a topic for another day. If you're married, filing separately, you're not eligible. So if you've a married taxpayer and you had $10,000 worth of overtime and you filed separately, you can't deduct this overtime. Sorry, got to file joint. It does have limits, so income limits. So the deduction does phase out for those with modified adjusted gross income above $150,000 for single or $300,000 for joint. So if you're a married couple and you made $200,000, your modified adjusted gross income, you'll be able to claim the full deduction because you're under the joint limit. Same with if you're at $125,000, you'd be able to claim it. Now, they do start phasing out. For every $1,000 over the modified adjusted gross income limit, the deduction is reduced by $100. So you can see where this can be limited as a filer. So if you're a single filer and your modified adjusted gross income was $15,000 or $155,000, you can claim a max deduction of $12,000 since you're $5,000 over the limit. So you deduct $500 from that $12,005 that you would be able to. Now, what's deductible? It's only the time and a half portion, only the extra half above your base rate qualifies. So if you make $24 an hour, we'll say, and you're going to get time and a half, be 36, the $12 an hour is what is deductible. Also, let's say your normal rate is $20 per hour and you're paid $30 per hour for overtime. Only the $10 is available for extra pay. So you got to be ready to calculate it. You got to know what your straight rate is and then what your half rate is. So we will have to figure that out for you and making sure that you're getting there. Tips earned during overtime hours do not qualify. Instead, you may qualify for the no tax on tips. Another discussion we'll have to have another day. That's out there. So just remember, they do have for 2025 a 1-year safe harbor rule, and it's only for 2025 that lets employers average your overtime hours from the second half of the year, July to December, to figure your deduction. This rule is meant to ease the transition into the new overtime tax law, which wasn't passed until midway through the year. So if they weren't separating out overtime on your paycheck, they would be able to use this to average your overtime for the whole year based on what overtime you did in July through December. Now, reporting requirements for your employer. This is where it's become tricky. Employers were not required to provide a separate breakdown. And the IRS is providing penalty relief for employers and payers who are not able to report these figures. So that means overtime premium may appear in different places depending on your employer's payroll system. Some may report it in box 14 as other on W-2. Others will include it on a year-end earnings statement, or provide no separate line at all, leaving you to calculate your deductible overtime using your pay stubs or pay records. Now, just remember, this is a transition year. IRS allows several reasonable methods for calculating your deduction. So you're going to have to look at how I'm going to calculate this and make sure that you get it right. But beginning in 2026, employers are then going to be required to separately report qualified overtime compensation on the Form W-2 and other information returns. Whew. So just got to remember that, hey, this is the first year doing it. There is safe harbor. We've got to go through and calculate this. Your employer is not required to put out as much information as you would think would be on your paycheck stub. And some of the stuff we're just getting in the first of the year and this month. So we're now seeing, hey, exactly how they're going to report overtime pay. And many of the phone calls we've gotten is, hey, I received this overtime pay, but it's not anywhere on my W-2. We've referred a lot of people back to their employer to ask the question. But we also now know that we can use your last paycheck stub if it shows year-to-date numbers and get your overtime pay that way, and then be able to calculate backwards how much you would have had in extra half overtime pay. So if your extra half totals, more than the 12,005, you're limited to 12,005. So what we're going to be able to do is look at your regular hours, regular pay that you work, and be able to get in and figure out what your normal rate is. Be able to multiply that by time and a half to figure out how many hours is actually listed in overtime there, and be able to extrapolate the rates from there. Maybe, if we're lucky, your employer gave you a separate overtime breakdown. And, if the employer did do that separate breakdown, we'll be able to use that. Maybe they listed it in box 14. We'll be able to pull the number from there, just so that we can make sure that those numbers are right. Now, you can go to the IRS website, and there's some other places that you can go in and look at what are some of the approved methods of calculating it. Because we do have safe harbor, we're going to make sure that we're covering the overtime pay as best as possible and getting you the biggest deductions there. They do have some other provisions within this for like law enforcement, fire protection, hospital workers, and others covered by special Fair Labor Standards Act. And we can kind of go through all of those with you when you're a client, making sure that, hey, you're getting all the deduction that you possibly can. So again, this is not permanent, only through 2028. No, you're not deducting your overtime tips. You may be able to apply it to the no tax on tips deduction. Employers in 25 don't have to give a special report, but most employers have it listed on your paycheck stub. So you want to go out there and make sure you're doing it. So bottom line here, there's no tax on overtime. Deduction is a major new tax break for millions of people working in America, cutting federal taxes by cutting the tax on the extra hours that you're working. And it means more money in your pocket. So make sure you're getting that deduction. Hey, as usual, we're running short on time, and man, we're coming to the end. We're here every Monday at 10 a.m. Eastern Time on Tax Talk for You. You can tune in here on W4CY Radio. Connect with us over on Facebook or even at taxtalk4u.com. And that's tax talk, the number 4, letter U.com. Follow us over there so you never, ever miss an episode. You can also catch all of our podcasts over there as well. We're glad to be here bringing you information. If there's ever any questions you have, hey, send them to us here at the show, or you can send them through our Facebook page, or send them through Taxation Solutions or Trucker Tax Tools. we're here to help you every day. As always, have a God-blessed and glorious week. We will see you right back here at 10 a.m. Eastern Time every Monday on W4CY Radio. Thank you again, and God bless.
Are you an individual or business that wants to understand taxes and how they affect you? Are you looking for specific tax advice for self-employed, business owners, and truckers? Are you behind on taxes and your bookkeeping? Are you dealing with the IRS and ready to have some relief? Then you need Tax Talk for You, hosted by tax and trucker expert Barry G. Fowler, EA. Tune in 10 a.m. Eastern Time every Monday right here on W4CY Radio and Talk4 TV. Don't forget to check this and past episodes at taxtalkforyou.com. See you next week at W4CY.com.